This is Macro Horizons, episode 316, Transitory. Really? Presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 24th. And now that Powell has called up Transitory from retirement, we are looking forward to a visit from our old friends Conundrum and, of course, Irrational Exuberance. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the biggest event without question was the FOMC decision to keep rates unchanged and announce a material slowing to QT, as well as the updated SEP and the dot plot. The biggest takeaway from the dot plot was that the Fed stuck with the messaging of 50 basis points worth of rate cuts between now and the end of 2025. This dovetails well with our own expectations for the Fed to cut 25 basis points in September and then again in December. The clear takeaway was that the Fed does intend to resume the process of normalization at one point. However, the increased amount of uncertainty created by Trump's trade war has left the Fed uncomfortable cutting rates at the moment. The updates to the SEP included a higher unemployment rate and a slower growth profile for 2025. This is relevant insofar as it's a clear acknowledgement of how the Fed is reading the risks associated with the trade war. Bad for growth, with a bias towards higher unemployment. It's also worth a nod to the fact that Powell has characterized any increase in inflation related to higher tariffs and levies as transitory, and therefore unlikely to warrant a monetary policy response. We'll argue that the trade war has already triggered a policy response in the form of delaying rate cuts. That being said, we're no longer hearing any conversations about the potential for rate hikes this year, which is a positive development from the perspective of a bull steepening bias, which we continue to hold. The data in the week just past was relatively benign, although we did see the February retail sales print. Retail sales in February were disappointed on the headline level, but the control group measure showed solid growth, and as a result, the Atlanta Fed's GDP Now tracker came off of negative 2.6 and is now tracking closer to negative 1.5. It's still early enough in the data cycle that the tracking estimates of Q1 real GDP are going to remain volatile. It's not until we're in calendar Q2 before those estimates become particularly relevant. The price action in the week just past was constructive. We saw a drift towards lower yields. The range of 425 to 435 that had been holding broke, and it broke to the downside. We also saw the 10-year yield move below the 200-day moving average, which is a constructive outcome, and we would expect follow-through, all else being equal. The market has undoubtedly moved beyond trying to gauge the Fed's reaction function to the trade war to simply incorporating the Fed's recent updates and moving on. In practical terms, that means that the U.S. rates market is back to trading the incoming economic data as well as headlines from the White House and the evolution of the geopolitical environment.
Well, to no one's surprise, the Fed left rates unchanged this week, but that's not to say there was no new information revealed on Wednesday, with some reasonable tweaks to the language of the committee's statement, obviously an update to the dot plot that still showed 50 basis points of cuts as the median projection for this year's path of policy rates, some significant revisions to the growth, labor market, and inflation outlook, and of course the change to QT that's going to be going into effect on April 1st, as the committee followed through with what was laid out in the minutes of the January meeting, was slowing the pace of the balance sheet runoff to now just $5 billion a month in treasuries. This all resulted in a fairly textbook reaction from the market's perspective, as the curve bull steepened in response to what we'll argue was maybe a relatively hawkish expectation going into the Fed, and a measured to slightly dovish result was enough to bring 10-year yields lower and through the bottom of the yield range we'd been tracking after the market had spent the bulk of the last several weeks in coiling mode in anticipation of the Fed's rate decision.
And I think that the big debate at the moment is whether or not the price action was a response to, as you point out, more hawkish expectations going into the event than what Powell was ultimately able to deliver, or alternatively, the bull steepening could simply be a policy error response, i.e., the market interpreting what the Fed is doing, which is delaying rate cuts, as increasing the probability of a more significant slowdown, whether that comes in the form of a continued drag from net exports or if it leaks through to the consumption data remains to be seen. But clearly from investors' perspective, the narrative is now focused on the risk of an economic recession. Now, the degree to which that recession is focused in the U.S. versus globally, I'll argue, is a key nuance to the extent to which the Treasury market can rally from here. We did come into this week expecting the range to break in one direction or another, and the fact it broke toward lower yields certainly offered some solace for our medium-term constructive outlook on the market. It's also notable that Powell dusted off the transitory characterization of inflation. This time, it's the inflation linked to tariffs and the trade war. However, the word usage certainly wasn't lost on us, even if there's no great deal of implied intent on the part of the chair. With that observation made, it is worth noting that the Fed funds futures market is still pricing in more than 50 basis points worth of rate cuts this year. Although in conversations, it appears that most market participants are looking for 2 25 basis point cuts. It's a question of timing. We remain in the September and December rate cut camp, and we'll argue that that will provide the Fed more than sufficient time to interpret and incorporate anything that comes out of the White House between now and this summer.
And while the median Fed funds forecast didn't change, 2 more cuts expected this year, 50 basis points in aggregate of more easing, the composition of the dots for the 2025 Fed funds forecast changed meaningfully enough that it's worth acknowledging what that means for the timing discussion of the next cut, as you touched on, Ian. And what I mean by this is that even though the median didn't change, the overall distribution of committee members' forecasts for where they see Fed funds ending the year shifted higher, as there's a greater expectation that there's only going to need to be one more 25 basis point cut this year. And so in pondering what that means for the chance of a May, June, or July cut, it seems at this point that the risks facing the inflation outlook are outweighing the growth concerns and tightening in financial conditions resulting from the moves in the equity market in terms of dictating how monetary policymakers see the evolution of the forward path of rates over the balance of this year. It's a not dissimilar dynamic to what we saw in the early days of the hiking cycle, where the Fed was clearly willing to risk a higher unemployment rate, maybe even a technical recession, in order to maintain the central bank's credibility as an inflation fighter. And so, the fact that even after the developments in the real economy and in the market that have taken place since the January meeting, the distribution of risks around more or less rate cuts this year is still skewed toward less, is telling, given that it demonstrates that same reaction function is still in place at the Fed. And that is how, even with fairly significant downward revisions to GDP and upward revisions to unemployment rate forecasts, you still have the average, not median, policy rate forecast moving higher instead of lower.
And at its essence, the SEP update implied that the Fed's interpretation and the way in which it's choosing to incorporate Trump's trade war is as a negative for growth when an upside for the unemployment rate. And again, there will be some temporary inflationary pressures, but the Fed seems content to look beyond that for the time being. We share the Fed's concern regarding the funding market, and so the decision to materially decrease QT certainly resonates. By dropping the monthly runoff to $5 billion from $25 billion, the Fed has, for all intents and purposes, ended QT. $5 billion versus a $6.8 trillion balance sheet is little more than a rounding error at this point. That being said, there's still a reasonable debate about whether or not once the debt ceiling is resolved and TGA is replenished, if the Fed chooses to ramp QT back up to that 25 billion mark. It will be interesting to see how it plays out. All else being equal, we expect that the next move in QT will be to end it completely, as opposed to increasing it back to 25 billion per month.
And the unifying theme of the conversation around the balance sheet that we had with clients after the Fed was, what's the point of $5 billion a month? A line of questioning that frankly we agree with, and our explanation is that from a messaging perspective, the Fed wants to give the market the impression that there's no reason for alarm in the funding market, and this slowing, not stopping, of QT is simply out of an abundance of caution surrounding the state of the funding market and in order to be prudent in terms of risk management around the implications from the debt ceiling. So rather than attempt the wordsmithing challenge of stopping QT, but we mean it, we might restart it again, the Fed opted to keep the effectively negligible rundown of SOMA in place as a way to signal that shrinking the balance sheet is still important. But based off our conversations, there's a great deal of skepticism that QT is going to be renewed in any meaningful way. The biggest argument for that, on the other side of the TGA rebuild that will happen sometime in the second half of this year, is that the Fed will want more capacity to increase the balance sheet if in fact another QE program is warranted at some point down the line. But at this point, your characterization, Ian, certainly has resonated in the market, which is that QT has basically come to a stop. And now the next question will be when and how the Fed endeavors to shift the composition of SOMA to shorten its weighted average maturity to more closely align with the market. Some sort of twist program will likely be coming from the New York Fed, and we'll be keeping an eye out around the May and August refunding processes for any line of questioning in the survey of primary dealers as the Fed starts to solicit feedback on what such a program will look like. But the punchline is there's probably going to be more demand coming from the central bank for the bill market.
And I think it's worth noting that our expectations in this regard is that it will simply be a reallocation of the maturities, and the portfolio will be realigned via auction add-ons as opposed to outright sales or purchases in the Treasury market. If the Fed chose to conduct outright coupon purchases in the front end of the curve, that would be notably more supportive and contribute further to our bull steepening bias. In a recent conversation, the observation was made that we spend a fair amount of time talking about the asset side of the Fed's balance sheet. The liabilities, however, tend to not be as much of a focus. And I think that one of the reasons for this is that when we think about what are the primary liabilities for the Fed's balance sheet, they include bank and Treasury reserve balances on deposits, as well as the currency in circulation. And let us not forget, we also need to consider the movements in the TGA. And so we tend to think about the TGA as the most volatile or the most interesting aspects of the liability side of the balance sheet, primarily because of the implications from the debt ceiling and the tendency of the debt ceiling debate to push the Treasury Department to extraordinary measures, which then requires the Treasury Department to run down the TGA, or the Treasury's general account, closer to zero. And then once there's resolution, the Treasury ramps up bill issuance to resupply TGA. The other major component in the current environment is bank reserves. Now, bank reserves aren't necessarily stable per se, but the Fed is comfortable with an ample reserve regime. And as we have seen, the Fed's QT efforts have drawn down the reverse repo program from what was $2.5 trillion plus to now less than $200 billion. And that was clearly a significant draining of excess liquidity and shifted the size of the Fed's liabilities as well.
And it's this dynamic around the level of reserves, the ebb and flow of liquidity in the front end, the drain that we've seen in RRP, that informs our take and the market's take that in terms of the risk reward around the Fed re-ramping up QT or just allowing this negligible pace to continue running or stopping it altogether, while there was once a time that getting the balance sheet back to pre-COVID levels was very high on monetary policymakers' list of priorities, now it seems that that prioritization has changed. After all, if the benefit of aggressively running down the balance sheet is simply just having a smaller balance sheet, whereas the potential cost is pushing the financial system back into a scarce reserves paradigm similar to what we saw in 2019, there's enough asymmetry there, given the critical importance of a well-functioning money market, that means that the Fed will be comfortable with a larger balance sheet for longer, because the benefit of that is we won't need to worry about spikes in SOFR or material dislocations in the funding market around quarter and year ends. So from that perspective, a large balance sheet is probably going to be a semi-permanent feature of the Fed for the foreseeable future.
And if nothing else, Ben, one of my key takeaways from this conversation about the Fed's liabilities is that while they do have a lot of liabilities, they don't have as many liabilities as they would if you and I worked there.
That's a fact.
In the week ahead, the Treasury market will have a full round of supply, starting with $69 billion 2 years on Tuesday, $70 billion 5 years on Wednesday, and ending with $44 billion 7 years on Thursday. The data slate is also relatively full. We do have the Conference Board consumer confidence figures for March. Given the disappointment we saw in this series for February, it wouldn't be surprising if there was a fair amount of price action associated with whatever is published from the Conference Board on Tuesday morning. Perhaps the most potentially market-moving data release comes in the form of Friday's core PCE figures. This is data for February, and the consensus is for a high 0.3 or a low 0.4. Recall that even though the core CPI and core PPI figures came in lower than expected, translating all the components through to the Fed's preferred measure of inflation still puts core PCE at 0.3% on a month-over-month basis, and suggests that while inflation is certainly off of the highs seen during the pandemic, there's still some progress to be made before inflation returns to the Fed's objective. The market will also benefit from a variety of incoming Fed speak, the highlight of which being Williams on Tuesday morning. We'll be eager to hear any nuance that Williams is willing to add in regards to the probability that the Fed chooses to delay rate cuts into 2026, or whether there is simply a collective sense that cutting rates sometime in the second half of the year is the path of least resistance, and quarter-point increments should be a given. To a great extent, that's our base case scenario, with the one caveat that the performance of risk assets remains very relevant at this stage in the cycle. Equities are already off of their highs, and a continued sell-off would serve to tighten financial conditions. Tighter financial conditions, when inflation is a bit stickier than the Fed would like to see, certainly isn't a wholesale negative outcome. And in fact, the Fed is likely happy to see some of the extremes come out of the equity market. In keeping with this observation, the wealth effect has surely contributed to some of the sticky pockets of inflation, and as equities have already moderated, and if they sell off further, there's a compelling case to be made that this will serve as a disinflationary impulse for the U.S. economy. The risk, as is often the case, is that the move begins to snowball on itself, and instead of the S&P 500 being down 3 to 5% on the year, we find ourselves in a situation where it's down 10 to 15% on the year, and that's going to have ramifications for demand, that will have ramifications for the employment market, and ultimately, that should have ramifications for how quickly the Fed chooses to resume normalization. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we watch the Fed's projections for 2025 get revised and revised again, one thing is clear: no conviction was harmed in the making of the SEP. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.